What's up everyone, it's Karthik with MoneyVest. So in this video, we are going to be talking about the Federal Reserve interest rates, S&P 500. I'm going to give you a full data-driven analysis on the markets as we just came out of the last couple weeks of brutal selling pressure with aggressive liquidation in technology stocks, almost $3 trillion worth of value getting wiped out of global markets here. We are definitely in the midst of some very, very volatile and uncertain environment. And I really want to put things in perspective, cut out all the noise, and really help you understand what exactly is going on, because we are in a pullback slash correction for the NASDAQ and for the S&P 500. So I really want to break down a lot of data here in this video. I've spent a lot of time putting together a lot of spreadsheets for all of you, which we are going to discuss. So this right here are going to be some of the spreadsheets that we are going to go over in this video. It's going to be super, super helpful. I can't wait to get started. All I'm asking in return is that you drop a like and share this video with other people that might be interested in learning more. This is the data that we like to look at to better understand the dynamics around market sell-offs, bear markets, and recessions so that you can make more confident, better informed decisions when it comes to your own investing journey. So all I'm asking in return is that you drop a like and share this video with other folks through WhatsApp channels, Discord groups, Telegram, whatever it is that you use. Please do share, consider sharing. It's word of mouth and referrals like this that help us grow our channel. So first things first, let's talk a little bit about the markets themselves. So as we witnessed, S&P 500 is in a nice little pullback. We are not in a correction yet. So I want to be very clear. There are different parameters that we have set for when the S&P is in a dip versus pullback versus correction versus bear market versus a crash. So S&P 500 right now, as it stands, is very much in a pullback because it's down a little bit over 5%. So if you take a look at the all-time highs of well over 5,664, we right now from our all-time highs are down just over 5.6%. So we are in a pullback because we breached that 5% threshold. If you come over to the NASDAQ composite, which is ticker symbol IXIC, from its all-time highs of 18,650, we are down a little bit over 10%. So we breached that 10% level. So now the NASDAQ's in a proper official correction, and Magnificent 7 is down, of course, more than that. If you come over to this right here is the index that I've created on TradingView for us to track. We are down a little bit over 13%, also in a correction. This was in a correction prior to the NASDAQ entering a correction because that's how it works. Individual stocks sell off faster and more aggressively than the aggregate indices, and that's why you'll notice that on our website, you'll see a lot of these individual stocks showing us correction, pullback, bear markets, so on and so forth. So you can see the S&P 500 also showing us a pullback. NASDAQ is showing us a correction. The Dow Jones is still in a dip because it's only down over 4% from its all-time highs. You know, this could also be down over 5% at some point. And it also shows you a lot of other status checks for individual sectors, whether it's materials, real estate, communication services, utilities, healthcare, IT sector, discretionary staples, all that good stuff, plus individual stocks, right? So AMD, Qualcomm, Salesforce, Adobe, all of them are in a bear market down over 20%, including Tesla, Nvidia, Broadcom. Everything's in a bear market down over 20%. And again, some of the more Magnificent 7 companies like Google, Amazon, Meta, Microsoft in a correction. Apple's the only one that's kind of holding up really well, still down 7% from all-time highs in a pullback. And Oracle is another stock that is only in a pullback right now, down over 9% from its all-time highs. The moment these two companies kind of breach that 10% level, we are going to be in a correction for those two as well. And at that point, I do believe S&P 500 to be in a bit of a correction as well, and down almost 10% from its all-time highs. Now, coming back over to these spreadsheets. And what we have done here is, by the way, eventually a lot of this data is going to make its way over to the MoneyVest platform. So don't you worry, a lot of you guys, everyone, all the members will have access to all these spreadsheets and all this in a really well-presented UI so that you can make your decisions, you can make your analysis yourself. But if you come over to first things first, volatility, right? Volatility is at 23.39. So we are at the 76th percentile. We got up to as much as 29 to 30. So you'll notice that at one point we were at here, 28.9, and we were in the 90th percentile. So the way we have calculated this numbers is essentially going back as far as 33 years. So we have total observations of 8,514. Okay, this is the data that we have collected on our backend and then done a lot of calculations and simulations and run a lot of statistics here on our Excel spreadsheets to better figure out, okay, based on 33 years worth of data on volatility, 8,514 observations, what is the percentage of times volatility has spent in at certain levels, whether it's above 60, above 70, above 20, below 10, below 20, things like that, to better figure out what is the percentages breakdown for volatility. And since we are above 20, but a little bit under 30, we are at 3,296, so 38.7% of the times in the last 33 years, volatility has spent above 20, but below 30. And that's where we are right now. We're just over 23, and we are in the 76th percentile. And the higher it actually goes, the higher, of course, it goes in percentiles from 90, 95, 98%, 99%. And take a look at this, right? This is how interesting it becomes. Because of such a rare event in volatility, up until 47 VIX, we are in the 99 percentile. The moment it breaches 76 to as much as 81, we are in the 99.95 and then 99.99 percentile. I mean, this is about as rare as it ever gets. This is the most extreme level on the volatility. So the idea here is the moment the VIX crosses certain levels, we're talking 30, 33, 41, 47, and we're getting up to that 90, 95, 98 percentile, it's getting more and more rare for volatility to be there. Hence a huge buying opportunity in the markets because there's a lot of panic and there's a lot of uncertainty at the moment. Now, coming over to S&P 500 bear market declines. Now, this is really what I want to share in this video because what we did here is going back as far as 1950s, and we tracked down all the bear markets the S&P 500 has experienced, and bear markets are a sell-off of over 20%. Remember, a bear market is when the S&P 500 from its all-time highs is down over 20%. So we went back to 1950s, right? So we're going back over 70, 75 years, trying to figure out how many times the S&P has entered a bear market, what was the duration of those bear markets in terms of months, how many months was the S&P 500 in a bear market, and what was the decline from all-time highs. And the red and the green color codes are simply whether that bear market was accompanied with a recession or not. So if it's red, that means the bear market was also accompanied with a recession. If it's green, the bear market was not accompanied with a recession. Because this entire sell-off is happening on recession fears, we're seeing the markets get more and more defensive, right? So markets are becoming very defensive right now because of these recession fears. A lot of people are expecting a recession to happen anytime, any month here over the next several months here. And also at the same time, we're seeing unemployment numbers increase. We talked about this in our yesterday's video. Yesterday, we got the unemployment numbers and Sam Rule also got triggered for a potential recession. The yield curve is uninverting. There's a lot of recession fears in the market. So that's exactly what this spreadsheet tracks, is what bear markets were accompanied with a recession and which ones were accompanied without a recession. So going back all the way to 1950s, our research basically found, as you already would have guessed, that with a recession, the bear markets are longer lasting and more severe, versus when there is not a recession, the average and the median sell-off in the S&P 500 for it to be in a bear market is only 6 to 7 months. Meaning that when there is not a recession and the S&P is in a bear market, let's say we're down over 20% from all-time highs, on average and on median, it's only spent 6 to 7 months down more than 20%, and then it's recovered. And the sell-off from all-time highs also has been significantly less than when it was accompanied with a recession, meaning that when there is not a recession and the S&P is in a bear market, on average, on median, we spend about 7 to 6 months respectively, and we only see and experience a sell-off of 20 to 23% on average on median. That's very reasonable. That's a very contained sell-off of 20 to 23%. That's not a huge sell-off in the markets. Still pretty big in the context of course, the economy and again, the market cap loss. But 20 to 23% is still pretty contained, I would say, in the context of a bear market that is only lasting 6 to 7 months. But that happens only when there is not a recession. When there is a recession, when the bear market is accompanied with a recession, you'll notice that the sell-off is more brutal and longer lasting. We're talking 16 to 17 months. So in some cases, almost 3 times longer the bear market lasts. And not only does it go down 20%, it goes down to as much as 36% if there is a recession accompanied with the bear market. And this is going back as far as 75 to 80 years. If you consider all scenarios with and without recessions, the median and the average sell-off is about 9 to 11 months. So just consider it under a year. And the sell-offs are somewhere between 27 to as much as 30%, which of course is the average and the median of these two over here. But I really want you guys to focus and understand, based on data, based on historical analysis of over 75 years, when the bear markets in the S&P 500 accompanied with a recession, they're longer lasting, almost twice, in some cases 3 times as more than when there is not a recession. And the sell-offs are also more aggressive, 35 to 36%. And volatility during those times, of course, is when it gets up to over 90th percentile, 95 percentile. We're talking 40 plus in terms of volatility because there's a lot of uncertainty in the economy and, of course, in the markets as well. So this right here, again, very, very important data points in my opinion. Now, if you come over to the rate hiking cycle, we've done something very similar going back as far as 1950s to better understand the Federal Reserve's interest rate hiking cycle. And over here, what we have is the starting date. In other words, when did the Federal Reserve actually start raising interest rates? What was the starting rate? The ending date, when did they stop raising interest rates? And what was that ending rate? And then how many rate increases did we experience? Believe it or not, 2022, when we actually got started with interest rate increases in March of 22, up until August of 23. So this rate hiking cycle, the cycle that we're experiencing now for rate increases, was ranked the third most aggressive in terms of rate increases on an absolute basis, meaning how much increases we saw, 525 basis points or 5.27% of rate increases in the last 29 months. So this has lasted 29 months because the Federal Reserve is very much indicated to lower interest rates in September. Everyone's expecting it. Pretty much the entire market is expecting it. Many people even expecting a jumbo cut of 50 basis points. So we're coming to an end of this interest rate hiking cycle. And this includes pauses as well, right? So this includes when the Federal Reserve decided to pause and keep interest rates where they are. So they essentially paused in August of 23. As you can see that we were at 5.33%. And since then, we've just been at that level, right? So we haven't really gone up, gone down. We've just been sideways, right? We're just been at that level. So this includes a pause, and that's lasted 29 months. And well, of course, by the time September comes, we're going to be talking 31 months, including August and September, so 31 months. But on an absolute basis, based on how much these increases were, 525 basis points, was the third most aggressive interest rate hiking cycle from the Federal Reserve. The only 2 times when we've experienced a more severe interest rate hiking cycle were both during the times of great inflation back in the 1970s and in the 1980s, when interest rates went up by over 9 to as much as 14% during times of Paul Volcker, of course, that really wanted to crush inflation back lower. So this is the third most aggressive interest rate hiking cycle from any Federal Reserve in the last 70 plus years on an absolute basis. And when it comes to the number of hikes we experienced on a monthly basis, right, because some hiking cycles were longer, some hiking cycles were shorter, you'll notice a maximum was 64 months. 64 months the Federal Reserve just constantly was hiking interest rates. This was back in the 1960s, but they were only increasing it by 459 basis points over that 64-month period. So that is still on a, I would say, a severity scale much lower, because they're not increasing by crazy amounts every month. It's a much longer hiking cycle, and it's a lower hiking cycle. But this time around, we were just as much as 1960s, right? If not more. 5.27% is more than 4.59 in half the time, in 29 months. So of course, the severity of this hiking cycle was significantly more than what we experienced back in 1960s. And of course, the economy now is much bigger. The debt levels are much bigger. So the impact is going to be significantly more from the Federal Reserve than what it was back in the 1960s. So hike divided by month and how much of that impact was, in that sense, we rank fourth out of the last 70 years of hiking cycle. And the only other few times, again, back in the 1970s and 80s, the Federal Reserve essentially increased interest rates by 20 to 30 basis points every single month. This time around, we experienced almost a 20 basis point increase every single month. Every single month, we experienced a 20 basis point increase in interest rates, and that was a ranked number 4 in terms of the severity and the impact of these interest rate hikes. So the bottom line is, because of such an incredible amount of interest rate hikes from the Federal Reserve, the impact on the economy is still yet to be seen, because there's a significant lag to which these impacts occur, right? Whether it's 6 months, 12 months, 18 months, there's still a big debate as to how long these lags are. But we're starting to see a lot of the signs early on. Unemployment is starting to move higher. Delinquency rates are starting to move up. Credit card purchases, total amount of debt in the U.S. economy circulating is at an all-time high. So it's very clear that most people, most consumers are shifting towards credit and shifting towards debt to fund their lifestyle, right? Because cost of borrowing, and there's no other opportunity either. There's no other sort of way out, because inflation still elevated. As we have discussed, prices are still higher from where they were 3 years ago, and prices on an absolute basis continue to increase, even that the rate of increase is going down, right? So that's the year-over-year change that most people quote. That's the CPI or the core CPI or the PCE number, that inflation's up 3%, 4%. That's the year-over-year number. But on an absolute basis, prices are still moving higher, and it's becoming more and more problematic for a U.S. consumer, and that's why they're relying on debt, they're relying on credit, and that's why it's going higher. And cost of borrowing, of course, very much elevated after having a significant rate increases over the last 29 to 31 months. So sooner or later, as we already know, things will start to break apart. And when they do, we already do experience something like this, where the S&P 500, let's say, enters a correction or a bear market, and then the question becomes, is the U.S. economy going to skirt a recession, avoid a recession? Are we going to really have a soft landing, or if there is going to be a recession? Now, nobody knows. Nobody has the answer to that. Everyone's going to just predict or guess. But keep a close eye on some of the early signs. I would highly encourage you to keep track of unemployment numbers, jobless claims, job openings, layoffs. I'm sure you've got industry analysis experience if you're working in particular industries. You have an idea of what the jobs market are doing, right? Keeping a close eye on HR department. What are they getting instructions wise from their company heads and CEOs and executives? And if this continues, if unemployment continues to accelerate, the likelihood of a recession only increases, which then, based on data, leads us to believe that this can be longer lasting and more severe in terms of a sell-off. So keeping dry powder ready to take advantage of when the markets are down, 20, 30%, because on average and on median, that's what we're going to experience if this were to continue. And then there's going to be buying opportunities, right? There's going to be buying opportunities because markets are going to come down to pretty attractive levels. So this right here is another spreadsheet which tracks the overall valuation of the S&P 500. And right now we're at 5,346. So you'll notice that based on today's level, since we are down over 6%, based on 2024 earnings of $244, we are trading at just under 22 times earnings. And based on next year's earnings of 2025 of $279, we're trading now at 19 times 2025 earnings multiple. Now, the interesting thing is that this spreadsheet will allow you to keep track of how this will change once the markets move higher or lower. So, for example, if you drop another 5 to 8% from these levels, the markets are going to be trading under 4,900 or closer to 5,000. It's going to show you how that valuation for the S&P 500 will change respectively, right? According to where the index level is, and based on the expected earnings, we're going to be expected to come down to 20 to as low as 18 times 2025 earnings multiple, or even 17 and a half. And then you can compare that with the historical averages, right? So on a 5, 10, 15, 20-year average basis, we have essentially been trading at around 18 to 21. So if it gets down to those levels, we are now considered somewhat undervalued as the markets continue to sell off, right? If the markets are down to a correction or a pullback or even a bear market, and we're trading down to 16 to 17 times earnings multiple, and volatility is extremely high, that would create a very, very solid environment for buyers to step in, to look at discounts, to look at deals, to dollar cost average into. So hope you all enjoyed this video and a complete update on the markets here. Don't be afraid. Don't be in a panic state, because this is very normal. This is, things that we have experienced before. I mean, as I showed you, rate hiking cycle. It's like this has happened plenty of times before in the last 70 plus years. If you come over to these bear market declines, this is not the first potential bear market or correction or recession. This has happened over and over and over again. As you can see, this is a whole list of every time it's happened before. So don't be afraid. Don't panic. This is part of the market. We go in cycles, and hopefully this is information helpful to you, and you can make strong, confident decisions. Join our community if you want to. Join our Discord, and we'll be here to help you along the way. And again, you can access all the members-only private videos, access all the platform data and analysis. We're going to make a lot of those spreadsheets that I just shared available on our platform as well, so you can take a look at all that data yourself. But again, link's going to be down below. We'd love to have you on board. And as always, happy investing. I'll see you all in the next video.